Okay, folks, welcome to a really quick morning update with regard to an announcement last night out of Fitch. They had downgraded U.S. long-term rating to AA plus from AAA. And what we're going to talk here is the historic timeline of a previous downgrade of U.S. debt back in 2011 by Standard & Poor's. We're going to talk about the reaction by the stock market immediately following that downgrade. We're going to talk about the Federal Reserve's response, not just to that downgrade, that wouldn't be fair, but ultimately what caused the equity markets to recover and move on to multiple all-time record highs. And we're going to talk about the yield curve. We talk about this on our live streams constantly. I talk about it on Market Wrap with members constantly, and expect some movement out of the yield curve very quickly. I'll talk about what that is in a moment, and we'll go over a couple of charts out of Keith McCullough from Hedgeye in a moment. So let's get to it. The reason why Fitch downgraded U.S. debt, Fitch Ratings cut the United States long-term foreign currency issuer default rating from AA plus from AAA. The agency had placed the country's rating on negative watch in May, citing the debt ceiling flight in Washington. Well, what happened there? What happened is that the Republican majority in Congress completely caved to the minority, not only lifting the debt ceiling, but providing no debate on a debt ceiling until 2025 with a minimum of additional $4 trillion in additional spending. Moving on. The repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management, Fitch said. U.S. stock futures opened lower Tuesday after the downgrade. We'll talk about that in a moment. In fact, let's talk about that right now. So the S&P 500, which is on top here, is down at current just over a half percentage point. The NASDAQ down here is down 0.83%, but rallying off the lows of the session. Volatility, believe it or not, is well off of its highs and is now broken back down below. This is the front month contract, has broken down below support at 16. And the 10-year yield, if you could believe it, is actually down on the session. So while the markets are, at least the equity markets are down in the pre-market session, we're not seeing aggressive distribution of stocks, but that's difficult for big institutions to do in the pre-market, given the fact that there's such light volume and spreads are so wide. So we can't read a lot into the pre-market price action here, but let's go back in time to get a feel for what happened back in 2011. To be specific, August the 5th, 2011. On Friday, August the 5th, 2011 was a sad day in American fiscal history. It was a day the credit rating firm Standard & Poor's downgraded the credit rating of the United States from AAA to AA plus, similar to the Fitch ratings. Now, the response, this is from the Federal Reserve Bank of Atlanta, who came out, and you can bet this is going to be out today in another form or fashion, out of the talking heads on CNBC. You're going to have the elite of the financial community coming out and ripping Fitch like there's no tomorrow. And rather than talking about the merits of the downgrade of the S&P decision back in 2011, they brought out Warren Buffett. So, critics to the U.S. downgrade. Standard & Poor's downgraded the credit rating of the United States from AAA to AA plus on August the 5th. That move generated a great deal of commentary. For instance, Warren Buffett told Fox Business Network the downgrade doesn't make sense. Think about it. The U.S., to my knowledge, owes no money in currency other than the U.S. dollar, which it can print at will. Now, if you're talking about inflation, that's a different question. I guess he was talking to Liz Clayman at the time. On Meet the Press, Alan Greenspan, the United States can pay any debt because we can always print money to do that. So there is zero probability of default. This has been the attitude of the United States for the past 60 years, that we could spend at will. Back in the 1960s, you had President Johnson, guns and butter. We're going to have a war, and plus we're going to have welfare driving this country into Richard M. Nixon taking us off of the gold standard in 1971, killing the buying power of the US dollar, forcing women out into the workplace, and destroying the nuclear family here in the United States. But Warren Buffett and Alan Greenspan don't seem to realize that. And you could be as certain, as sure as God made green little apples, that they are going to have the talking heads of all talking heads back out today, forcing them to a microphone, forcing them on television to bash Fitch for their downgrade. I'll bash Fitch. Where have you been since 2011? Why did it take this long? What you're looking at here is a chart of U.S. national debt from Q2 2011 when S&P did downgrade our debt. And you can see how our debt has just skyrocketed. And the driving force behind this ever-increasing debt load was the result of the response to this recession back here, which we could label the dot-com recession. But I think what happened here is that Fitch, looking at U.S. debt, looking at the political capitulation on the part of the Republican Party, realizing that there is a uniparty in Washington, and also looking at this. First, grasp this image here, rising debt, but here are tax receipts, U.S., state, and local income tax receipts. They are plummeting. So how do you pay off historic debt when you have tax receipts that on a year-on-year basis are negative versus the prior year? I'll leave that for you folks to answer in the comments below. Now, so we could get a feel for how the markets are going to behave today, let's take a look at how they responded to the actions by Standard & Poor's back in 2011. Highlighted here in blue is August the 5th, 2011. And you could see here that equities from the high of that day down to a trough corrected just shy of about 10%. They rallied and then put in a lower low, and you can see they recovered with this bullish key reversal bar, much as what you saw back here. Folks, if you don't know what that is, there's a link below, 5-part video tutorial on my top 5 favorite candlestick patterns, free, just so you understand exactly what these terms mean. So you can see that the equity markets recovered and went on to a multi-year bull market. How did that happen? Why did that happen? Well, just simply take a look at what the Federal Reserve did on September the 21st, 2011. FOMC statement announces Operation Twist to support a stronger economic recovery and to help ensure that inflation over time is at levels consistent with the dual mandate. The committee decided today to extend the average maturity of its holdings of securities. The committee intends to purchase, by the end of June 2012, $400 billion of Treasury securities with remaining maturities of 6 years to 30 years, and to sell an equal amount of Treasuries with remaining securities 3 years or less. So they bought long, sold short. This program should put downward pressure on longer-term interest rates and help make broader financial conditions more accommodative. So in short, this was the beginning of QE3. Now keep in mind this date, September 21st, 2011. What you're looking at here now is the yield curve. The yield curve has forecasted every single recession since 1955. Now, a quick overview of what the yield curve is. This is a measure of the spread of yields, 2s versus 10s. So short-term treasuries versus long-term treasury yields, 2 years versus 10 years. In a normal, healthy environment, shorter duration bonds are yielding less than longer term, driving the steepening of the yield curve. Unfortunately, that sends the market in the wrong direction. Overlaid here in blue, I have the S&P 500. In gold, I have gold. Now let's fast forward to what happened post, first, the downgrade of U.S. debt by Standard & Poor's in 2011. The equity markets initially did not take kindly to it, but what happened? Fast forward to September, Operation Twist, and the yield curve began to drop. What happened to equities? They began, again, S&P 500 in blue, began to rip up higher. This was all accommodation, and it set the stage for a multi-year inversion of the yield curve, driving short-term interest rates higher than long-term interest rates, which is unsustainable. We talk about this all the time. Now, what's going to happen moving forward? This is where it becomes a guessing game. Remember where we were back in 2011. We had just come out of the great financial crisis. Plenty of QE had been going on, QE1, QE2. Then you had Operation Twist. Plenty of money sloshing around into the equity market, driving equity prices up higher. Now, last week we had a GDP read of 2.4%. Great headline read. The only problem is the preponderance of that growth came from government spending, not the private sector. So back here, you had the economy growing with the help of the Federal Reserve pumping money into the economy. Currently, you have economic growth because the government is spending like drunken sailors, resulting in a downgrade of U.S. debt. So I think short term, you're going to get a response by the markets to the downside. Will it be as great as back in September of 2011? That's a guessing game. I don't want to play that game. I don't want to be overly bearish. I certainly don't want to be bullish. But traders will look back in time, as we're doing right now, and they'll say, what was the reaction by the market? They'll look short term, they'll look longer term, and they'll say, okay, that was a blip on the screen. Going back to the chart of the S&P 500, it actually set up for a beautiful W formation, driving equity prices up higher. History repeats itself sometimes. It usually just rhymes. This is a market that is extremely extended on a valuation basis. Take note of where we are at current with a PE ratio of nearly 32 relative to historical norms of 17.4, and relative to where we were back in 2011, just above 20 on the Shiller PE ratio. And on the Buffett indicator at that point in time, stocks on a PE basis were below historical trend in terms of valuation. This is a different time. So how are we positioned? I have been an advocate for quite some time of not being aggressively long of this market. Have over the past couple of months, have we left some money on the table by not being aggressively long of this market? Yes, we have. How are we positioned, though, heading into an event like today where you could see a swoon in the market? Because certainly this is one of those catalysts. We are neutral with a bias to the short side. So today we welcome this price action because we're going to be up this morning. But if this market begins to roll over and break down in earnest, those neutral positions with a bias to the short side, if we don't manage them and take profits appropriately, manage our winners, then that could become a portfolio like anybody else's that is in jeopardy of a binary event, meaning a swoon in the marketplace. So right now, consider yourselves lucky. Let's go back to the pre-market price action. That we have the equity markets down only less than half percentage point. NASDAQ 100, the triple Qs down spot 72%, rallying off their lows. Yields are now down on the session even more. VIX is stabilized, but still up on the session. This could be a lot worse. It could be a lot worse. So hopefully you took some notes. Go see your financial advisor. See what's right for you. Does he want to raise capital? He or she want to raise capital? Get a little bit less risk adverse, as we've been doing. And I would also ask that you show them this. This is a chart of luxury goods. I went over this last Sunday on Sunday Night Futures Live. If you're not currently joining our live streams, click that notification bell, please. Luxury goods consumption. So this is the rich. Luxury goods consumption year over year has been in a decline since October of last year. So the rich are digging in their heels. They are hunkering down. They are in the know. And also ask them to take a look at the NASDAQ 100 in white relative to the 10-year Treasury in red, which historically trade in tandem, and ask him when he believes or she believes that there is going to be a reversion to the mean. It could be an equal event of treasuries rallying due to the fact that monies are leaving equity markets and they'll meet somewhere in the middle. Or given the downgrade by credit rating agencies, it's been quite a while since S&P has spoken about U.S. debt. Perhaps they're going to downgrade at some point in time. That could be a fear. It's been a long time. So do treasuries continue their sell-off? And in fact, they broke down yesterday. Simply look at a chart of the TLT Here's a daily chart. This is the 20-year bond ETF. It broke critical support yesterday, sending yields up higher. And just to test your financial advisor, ask he or she, do they even know what the yield curve is? And go quiet. Have a profitable day, members. I'll talk to you tonight after the close. Be well.